Imagine you put $10,000 into what you thought was a solid investment. 30 years later, you check your account and see $132,000. Not bad, right? Except the guy sitting next to you invested the exact same $10,000 in the exact same market and walked away with $173,000. Same amount, same market, same time period. The only difference was something so small you probably never even thought about it. Today, I'm going to show you exactly what that difference was, why it costs most people tens of thousands of dollars over their lifetime, and how index funds, mutual funds, hedge funds, and ETFs all fit into this picture. Let's start at the beginning. What even is a fund? Think about it this way. You and 100 strangers all want to invest in real estate, but none of you can afford to buy an entire apartment building on your own. So you pool your money together, buy the building as a group, and everyone gets a share of the rent proportional to what they put in. That's a fund. You're combining money with other investors to buy a basket of assets, whether that's stocks, bonds, or real estate, that most people couldn't easily afford or manage on their own. The fund handles the buying and selling. You just own a slice. Now, here's where it gets interesting, because there are 4 very different types of funds, and the differences between them will literally determine how much money you end up with in retirement. So let's go through each one. Index funds. An index fund is the autopilot version of investing. Instead of trying to pick which individual stocks will win, it just buys everything inside a market index. The S&P 500 is the most famous example. It's basically a list of the 500 biggest publicly traded companies in America. Apple, Microsoft, Amazon, Nvidia, all of it. When you buy an S&P 500 index fund, you're buying a tiny piece of all 500 of those companies at once. Nobody is making decisions here. There's no analyst in a corner office trying to figure out which stocks to pick. The fund just automatically mirrors the index. That's why it's called passive investing. And because nobody is getting paid to make those decisions, the fees are almost nothing. Vanguard's S&P 500 index fund charges 0.04% per year. Fidelity has one that charges literally zero. That means if you invest $10,000, you're paying $4 a year at most. Compared to other options you're about to hear about, that number matters enormously. Here's what nobody tells you up front. Over the last 30 years, the S&P 500 has averaged roughly 10.3% annually. That means $10,000 invested back in 1995 has grown to around $190,000 today. No stock picking required, no financial advisor, no market timing. Just buying and holding the whole market and leaving it alone. One thing worth knowing: index funds only price once per day at market close based on something called the net asset value. If you place an order at 10 in the morning, it doesn't execute until around 4 in the afternoon. For long-term investors, this is completely irrelevant. You're not trying to time the market to the hour, but it's good to know so you're not surprised when your order doesn't go through instantly. Mutual funds. Mutual funds sound fancier than index funds, and the industry very much wants you to believe they are. Here, you're hiring a professional portfolio manager, someone with a Bloomberg terminal and an Ivy League MBA, to pick stocks for you. They research companies, read earnings reports, meet with executives, and try to build a portfolio that beats the market. This is called active management. The problem is the fees. The average actively managed mutual fund charges between 0.65% and 1% per year. That sounds small. It's not. Let me show you exactly how this works with real numbers. 2 investors. Both start with $10,000. Both earn 10% from the market before fees. Investor A is in an index fund, paying 0.03% per year. Investor B is in an actively managed mutual fund, paying 1% per year. After 30 years, Investor A has about $173,100. Investor B has $132,680. That's a $40,420 difference on a single $10,000 investment. Scale that up to a $100,000 portfolio, and you're looking at losing over $400,000 across a career. Not to bad investments, to fees. Here's what most people do wrong with mutual funds. They choose them based on last year's performance, the 5-star rating on the label. Recent data from S&P Global shows that among funds ranking in the top 25% of performers in 2020, not one of them consistently stayed in the top 25% for the following 4 years. 0. Past performance in actively managed funds is nearly useless as a predictor of future results, but fund companies plaster those ratings everywhere because it sells. Here's the uncomfortable reality about the industry, too. Nearly 64% of mutual funds from 20 years ago don't even exist anymore. They got quietly shut down or merged into other funds to bury their poor track records. It's called survivorship bias, and it makes the funds that survived look far more impressive than they actually are on average. The whole system is designed to make active management look more successful than it is. And while we're at it, let's talk about the advisory side for a second. Only about 5% of financial professionals are fee-only fiduciaries, meaning they're legally required to act in your best interest. The rest operate under a looser standard, where they just have to recommend something that's considered suitable. Think about what that really means. They don't have to give you the best option, just an acceptable one. And 73% of investors don't even know exactly how much they're paying in fees. The industry counts on that confusion. Hedge funds. Hedge funds are a completely different world. These are private, exclusive funds available only to accredited investors, which means you need either a net worth above $1 million or an income above $200,000. Minimum investments typically start at $250,000. Many require $1 million just to get through the door. They use aggressive strategies most regular investors never touch: short selling, leverage, derivatives, things that can generate massive returns in a good year and catastrophic losses in a bad one. The fee structure is what really sets them apart. It's called the 2 and 20 model. That means 2% of your total assets every year, regardless of performance, plus 20% of any profits the fund makes. In practice, current industry averages have drifted closer to 1.5% and 16%, but the principle is the same. The math is brutal here. Let me run it. Assume you invest $10,000 and the fund earns a gross return of 10%. After 2 and 20 fees, your actual net return is closer to 6.4%. Over 30 years, that leaves you with about $64,300. Compare that to $173,100 sitting in the index fund. The hedge fund cost you $108,800 extra on a $10,000 investment. And here's the thing that should really sting. Most hedge funds don't even earn that 10% gross return. From 2011 to 2020, the S&P 500 averaged 14.4% per year. Hedge funds averaged just 5%. Warren Buffett famously made a $1 million public bet that a simple S&P 500 index fund would outperform a portfolio of hedge funds over 10 years. The index returned 126%. The hedge funds returned 36%. It wasn't close. Now, I know what you're thinking. If hedge funds underperform and charge massive fees, why does anyone use them? This is where your brain is working against you. Behavioral economists call it complexity bias. We instinctively trust things that seem more sophisticated. Hedge funds feel smart. They feel elite. And that feeling overrides the actual data for a lot of wealthy people. The research on this is consistent. Complexity makes us more confident in a decision even when that complexity is actively hurting our results. Don't let your brain sell you on a worse outcome just because it sounds impressive. ETFs. ETFs, or exchange-traded funds, are essentially index funds with one key difference. They trade on the stock exchange throughout the entire day, just like a regular stock. You can buy shares at 10:17 in the morning and sell them at 2:43 in the afternoon if you want. You can see the price updating in real time. That flexibility is the main selling point. The fees are just as low as index funds. Vanguard's VOO charges 0.03% per year. The global ETF market hit nearly $19.85 trillion at the end of 2025. This is where the money is flowing. Because the combination of low costs, flexibility, and diversification is hard to argue with. Here's what most people do wrong with ETFs, though, and it's a big one. Because they trade like stocks, people start treating them like stocks. They check prices constantly. They panic when the market drops 3% in a day. They sell. The data on this is painful. A major study of over 66,000 households found that the most active traders underperformed buy and hold investors by 6.5% per year. The tool is good. Human using it keeps breaking it. In 2024, the average equity fund investor earned 16.5%, while the S&P 500 returned 25%. That's an 8.5 percentage point gap. Not because the funds failed, but because people kept buying high and selling low. Investors pulled money out of stocks in every single quarter of 2024, including right before some of the biggest rallies of the year. A $100,000 buy and hold investor ended 2024 with $125,020. The average active investor ended with $112,774. That's $12,246 lost in a single year to nothing but impatience and bad timing. So, there you have it. But make sure to subscribe if you want more videos like this.